So the time, okay, thank you. Okay, so let's get started. Hello, everybody. My name is Sarah Guizzo. I am a business advisor in Vancouver. Welcome, everybody. Thank you for joining us. We are going to have a lot of fun today. This is the ultimate beginner's guide to understanding financial literacy and accessing capital. So before we begin, I would like to acknowledge that I live and work on the unceded territories of the Musqueam, Squamish, and Tsleil-Waututh nations. I am thankful for the ability to live, work, and gather on this land. So I invite you all to write in the chat on whose traditional territories you are joining us from. Also, at the end of this session, we would like to hear from you about further topics that you would like WeBC to explore. We will be submitting a poll at the end of the session, so watch out for that. Okay. So welcome. Like I mentioned earlier, my name is Sarah. I am a business advisor at WeBC. My contact information is Sarah with an H at we-bc.ca. So before we begin, I just want to more about WeBC. So we provide that support for your small business journey. We offer financing to get your business started and operating capital to fuel your growth. We offer flexibility because we take that holistic approach and provide loans based on your business viability, not based on formulas. What this means we provide loans to a diverse range of women-owned businesses and support you with complimentary training, mentoring, and business advising. From essential business skills development to personalized business advice, we know the right questions to ask and the right resources to connect you with. Okay, so for today, here is the plan. We have a lot to cover. We will take about 30 minutes to go through all of this, and we'll have a lot of time at the end to answer your questions. So if you do have a question, be sure to pop that question in the chat, and my colleague, Netta, who's also on this call, will help me go through those questions at the end. Okay, so today's plan for today, we will talk more about capital. What is capital and when do we need it? We'll also look at our financing options, the personal credit score and why it's important, understanding agreements and their terms, interest rate, security and collateral, and then we'll finish off with our question and answer period. Okay, so let's dive deep. Let's talk about capital. So what is capital? Capital is that money or resources that are needed to open, operate, and profit within your business. Capital can come in many forms, and today we will talk about traditional loans, non-traditional loans, and equity and investment. So there are many needs that a business may have that are required for capital. So whether you're a brand new startup business and you're looking for money to get your product or service to market, or perhaps you're an established business and you're looking at growing and expanding and you need to hire new staff, take over new space, perhaps you need to do some marketing, or maybe you're in that acquisition stage and you're looking at acquiring your competition or buying out a partner. There are many needs within a business where you may need access to that additional capital. Oops, sorry guys. Okay, so when we are talking about capital, there are four main questions that you as a business owner need to ask. So the first one is money, of course. So what is your budget? Okay, where did you come up with that budget? How did you put those numbers together? Do you have real quotes, research to support that? Or perhaps your cash flow forecast is showing you that you need cash, on month 8 or so. So what exactly is that number and how did you come across that number? The next one is, what are the pieces? So what is my fit? What stage of business am I at? Am I new? Am I expanding? What type of business do I have? What industry am I operating in? What are my values and vision? And what is my timing? How quickly do I need access to this money? Who's involved in the business? Who do I need to talk to make a good decision? Perhaps your business has a board of advisors. Maybe you need to talk to your accountant or your banker or other partners within the business, or maybe even your lawyer. The last step here is, what do I need to do? So I figured out my budget. I know what my fit is. I talked to all the important people in my business. What do I need to do to move forward? So to start, we will start talking about debt financing options. So we will dig deeper into our financial institutions and credit unions. So those are our traditional lenders. So they may provide short-term and long-term financing needs. We also have our development lenders. So those are your non-traditional lenders. They tend to look at term loans over a longer period, finance a specific need or growth project. And of course, we have our lovely friends and family and business associates that maybe we can approach for short or long-term financing. So to start, let's look at our traditional lenders and options. So we have our financial institutions and our credit unions. So these are our traditional lenders. So when looking at the financial institutions, we've got the main 5 big banks: BMO, RBC, HSBC, TD, and Scotiabank. And we also have our credit unions, so Van City, Prospera, Coast Capital, and Vision, just to name a few of those lovely credit unions. What these institutions provide is both long-term and short-term needs. Okay, so when we're talking about long-term, we have term loans, which may be either secured or unsecured, or perhaps you're looking at working through the Canadian Small Business Loan Program, or maybe you're looking at a short-term need, which is your line of credit, which would be secured by your inventory or receivables. All of you on this call would already have access to a traditional lender, whether it's on the personal side, or maybe your business already has that relationship set up. These lenders can also provide advisory services, which may or may not be included within your loan, or may be offered as an additional fee. So when we're looking at traditional lenders, what exactly is it that they're looking for when they're thinking about, taking on new clients or doing loans for them? So first and foremost, they're looking for that existing relationship. Are you an existing client of them, whether on the personal side or the business side? Do they know you? How long have you been a client, etc.? They're also going to look at your credit score, which we will dive deeper into later in this presentation. Or perhaps they're looking at any security that you may own that you're willing to offer as collateral for your loan. Of course, they're looking at your repayment ability. So those are your historical financials, if you have them, if you're an established business. What is your ability to repay, take on additional debt? If you're not an established business and you're new, they're going to start focusing on your forecasted cash flow. What is your ability to take on debt and repay that debt? Or perhaps they're looking at other cash and investments that you already have with their bank. And of course, lastly, they're looking at equity. So equity is always kind of that tricky term to understand, but what equity really is how much money you have personally invested. So those are shareholder loans, or how much money the business has retained in the business. So they take that money and they compare it to any other outstanding debt, whether it's debt that you already have in the business or new debt that you're applying for. So each lender has different requirements and risk tolerances. So these are what your traditional lenders will look at when you are applying for financing. Okay, so we spoke about traditional lenders. Now let's look at non-traditional lenders. So non-traditional lenders are your development lenders. They come on board to help you finance a specific project or growth need. So for instance, WeBC, we are a development lender. So what we do is we provide financing up to $150,000 for majority women-owned companies. Okay, so these lenders here offer long-term financing needs. Okay, so they do not provide your day-to-day banking like your traditional lenders would provide. Another development lender or non-traditional lender is BDC. So BDC provides both unsecured and secured lending for small to medium-sized enterprises at all stages of growth. We also have Community Futures. So Community Futures supports organizations that operate in rural areas. I always have a hard time saying that word, rural, but they assess their applications on a case-by-case basis, depending on where your business operates from. And of course, we have all the lovely folks at Futurepreneur. Futurepreneur provides financing up to $20,000 for youth that are under 40 years old. So those are our main non-traditional lenders. Okay, so how is the non-traditional lender different from a traditional lender? So like I've previously mentioned, non-traditional lenders, so your development lenders, they offer term loans. So with those term loans, sometimes they may be able to offer flexible repayment options. So that may include a principal postponement for 3 to 6 months, or an offering of principal postponement throughout another time during your loan. They provide a little bit more flexibility when it comes to repayment. Now with that, they sometimes may offer a higher interest rate. They may also require collateral or may not require collateral. All of these non-traditional lenders have existing partnerships and relationships with the charter banks and the other financial institutions. So they work in combination with those folks, okay? So they come on board again to help out with those specific needs that maybe your traditional lenders, your banks or credit unions, may not be as interested in helping with. So again, they fund that specific need, that long-term need. Okay, so what exactly do non-traditional lenders look for? So instead of being formula-based, those non-traditional lenders tend to take a more business viability approach. So they're looking at the future. What does this business have to offer, and can they repay our loan? So they're looking at the viability. Of course, they also take into account your repayment ability. So those are your historical financials if you're an existing business, or your forecasted cash flow if you're new or expanding, and any other investments, etc. They are also looking at security, as some non-traditional lenders do require security. And of course, just like your traditional lenders, they also look at your equity. But each lender has different requirements and risk tolerances. So their idea of equity may be more or less than your traditional lenders. Okay, so what about our friends and family? So friends and family can come on board as, offering a loan. Friends and family can invest also in a number of ways. And three of the main ways here is, maybe it's a gift. You have a full, $50,000 from your parents, no set terms of repayments. Wow, that's amazing. Your parents really believe in your company. So you would show that as a gift with no formal set terms of repayment. Or, you could look at setting it up as a loan, however you decide to set up those repayment terms, which may or may not include an interest portion. Or Perhaps your family and friends are looking at investing in your business. They really believe in your product or service. They want to be a part of it. So this is where they invest money in exchange for an equity stake or shares in your company. So those are 3 ways that friends and family can get involved in your business. Okay. So one important note here is when we are talking about money, it's really important that you match that need to your repayment option, okay? So if you have a short-term needs could include buying inventory, maybe to cover your day-to-day expenses, or you've identified a cash flow shortfall. You want to use a source of funding that has a shorter repayment. So some of those options may include a line of credit or a credit card, or even your working capital. So this is a source that can be payable within 1 to 12 months. Now, if you're looking at a long-term need, so this is an investment that may take longer to recoup your investment. For instance, if you're looking at buying equipment, leasing out a new space, hiring staff, where you don't see the immediate returns, it makes more sense to term that out, to pay it out over a longer term period, not using your day-to-day cash to finance that investment or your line of credit, but considering applying for a term loan, whether it's through your lenders, your non-traditional lenders, or friends and family. So that term loan is amortized based on the useful life of that asset or a strategic plan. Okay, so we've talked all about debt and the different options that are available to you. What about equity? So what equity financing is it's raising money by offering, portions of your company or shares to investors. So equity can come in a number of forms. You have your angel investors, your venture capital, crowdfunding, and even friends and family, which is not included on this slide, but they count as well. Okay, so you've determined that you need an investor. What is exactly that they are looking for? What looks like a good investor for a venture capital, for instance? Okay, so first and foremost, they want to see that there's evidence that they'll make money. Makes sense, right? It's their investment. They want to see a return on that. So they will ask for your business plan, maybe your historical results today. What is your market share? What is your potential for scaling? Is this a good investment for them to take part of at this moment in time? Of course, they'll also want to see how exactly you plan to use their funds. So whether you're using their funds to purchase inventory, to make your product, or maybe you've got a service and you're looking at expanding, so you need money to invest in a new marketing strategy, or perhaps you just need cash flow to service all the demand that your business currently has. At the end of the day, the investor is going to look at their return on investment, so that ROI. How much and how long will it take for them to make money off their investment? Okay, so we spoke about capital, we spoke about debt, we spoke about equity. Now you're at that moment in your business where you've determined, yes, I need capital. What do I need to do today to prepare for that? So let's go through that. Okay, so first and foremost, whether you're a brand new startup or you're looking to expand, if you're applying for financing or you're speaking to an investor, they will want to see a detailed, well-researched business plan. I want to bold, super bold, well-researched, okay? Take the time now to go through your business plan and really present the facts. Show the market potential. Show the viability of your business. You need to sell your business. You need to show that it is a good company to support through financing or investment. And ways that you can do that is through your business plan. So do the upfront work now to make sure that you have all those questions answered within your plan. So of course, that business plan will cover all your main points of a business plan. So for instance, your market, your strengths, weaknesses, opportunities, threats, any risks to your business or industry, your projected financials that are supported by budgets, quotes, what's in the pipeline. Do you have signed contracts already? Are you speaking to a big supplier that's really interested? What's your strategic plan, and what is your timeline to move forward? So just to keep in mind, when you are working on your business plans, it's a living, working document. That's your roadmap to success. It's not just a check box to check off because my banker is asking me for this plan. It's really important that you revisit that plan, you know, whether it's annually or every 6 months, or maybe it's monthly, you know, pull it out, because business is fluid and that changes, and so does your business plan. So it's a really good habit to review that and use that as your roadmap for future. Now, on top of the well-researched business plan, we also need to prepare a realistic cash flow forecast. So again, I want to super bold the word realistic. So when I say realistic, these are real numbers that make sense. You may be thinking, okay, so I'm talking to my bank, I'm talking to this venture capitalist, I want to show him these explosive numbers because that will sell it. Maybe, but to show those numbers, they're going to want to see that those numbers are actually legit, that you actually came up with those numbers from a reliable source. So you want to go ahead and do the research and make sure that those numbers are correct. Is that your primary market research, your secondary market research? What are your competitors doing, et cetera, et cetera. So you want to take the time to really go through that forecast and make sure that those numbers are correct and make sense. When I'm speaking with my clients, I typically ask them to prepare 2 cash flow forecasts. So the first one is their most likely, so that's that realistic cash flow forecast. And second is a worst case scenario. So worst case is I don't hit my anticipated numbers, but this is kind of where maybe I may hit if I don't hit my projections. What do? I always go to the worst case scenario. Why? Because it helps me and the entrepreneur identify their cash needs, when and how much that is. If we can prepare for a worst case scenario, then the business will have all the sufficient cash on hand to continue operations. So it's really important that when you go through those forecasts, that take the time, research, and make sure those numbers make sense to you. The next one is maintain communication with your lender. They are your friend, they are your partner, they want to see you succeed. So keep them in the loop. Share your financials, whether it's your year-end statements or your internal, your quarterly financials. Maybe you have a special win, or you're being featured on a podcast or a magazine. Share that information with them. They want to see your success. So if they are on top of what's happening with you and your business, when it's time for you to come to them looking for financing or additional financing, they're already pretty much aware of what's happening with you, okay? And they'll be better able to serve you. So don't forget, your lenders are your friends and they're good partners to have. Lastly is managing your credit score. So I will dig deeper into this in the next slide, okay? It gets its own special slide. Okay, so everybody on this call has a credit score. Who's pulled their credit score within the last year? Show of hands. Okay, that's good. That's a good habit. It's really important to pull that score annually. Why? Well, there's a lot of fraudulent, funny business that happens online sometimes. So by pulling your score, you can review any recent inquiries, and you can also see all the credit that's available to you. Okay, so it's really important to pull that score annually. So when we talk about our personal credit score, our personal score basically depicts your credit worthiness. Okay, and your credit worthiness is based on a number of factors. So it looks at the total number of accounts that you have open. Do you have one credit card and one mobile phone? Do you have 12 different credit cards and several other cards on file? It also looks at your total level of debt. So are you maxing out all your credit, or do you have access to it and you're not using? That's called your credit maximization. It also looks at your repayment history. Are you making your payments on time? Are they in full? Is it just the minimum payments? Are you all up to date? And it also looks at your number of inquiries. So if you are applying for multiple loans with multiple organizations, all of those companies or organizations would be pulling your score. So when you do decide to go out and apply, it's important to ask whether they will be pulling your score or not. So many, if there are quite a few number of inquiries on your personal score, it does negatively impact your score. So just make sure that you ask that question. Okay, so lenders prefer a higher score. So an average score is about 650. A lower score is in the 500s. A really strong score is in the 700s. Okay. So I spoke about pulling that score, your score, annually. There are two organizations that you can do that. The first one is TransUnion Canada and Equifax Canada. If I can give you one piece of advice in this presentation, it's to pay your credit on time. If you can't pay out your maximum payment, make those the minimum monthly payments on time. By doing that, you will keep your credit score at bay. Okay, so be sure that you are managing your personal credit and making those payments on time. Okay, so let's say you've applied for financing or you're looking at equity with an investor. You've been approved. Woohoo! Yay, you've been approved. So your loan has been approved. What is required of you next? Where do I sign? So in this next section, we'll talk about loan agreements and terms. Okay, so to start, we have a loan agreement, or otherwise known as a letter of offer. So this document lists all the details of your loan. So the loan amount, what you've been approved for, what is the interest rate, what is the repayment period, what other fees may be associated with your loan, and any other conditions. It also outlines the lender's right to collect on payments if you, the borrower, defaults. So every lending agreement is slightly different. It's very important that you read and understand the terms prior to signing. You may want to contact your lawyer or an advisor to have them review it and guide you. Okay, it's really important you take that extra time to make sure that you know exactly what you are entering into. Okay, so we spoke about the letter of offer. Another document that may be required for your business and for securing a loan is a general security agreement, also known as a GSA. You may or may not have heard that term before. So what a GSA is it allows you to secure a loan or financing with a specific or a certain type of security. If if the borrower defaults, it gives the lender or the creditor reclaim some of the assets that they may have noted in the GSA. So it can be either secured by tangible assets, so that's your equipment, maybe any other business assets that you have or inventory, or it can also be secured by intangible assets. So that's your accounts receivable, trademarks, intellectual property. So let's, for example, let's say you have a line of credit with BMO. BMO may ask you to sign a general security agreement, which gives them first charge to your inventory and receivables in the event of default. So those are your general security agreements. The next one is a personal guarantee. Personal guarantees is a legal promise made by the individual to repay any credit that's issued to their business using their own personal assets in the event that the business is no longer able to repay the debt. Okay, so even though your business is separate, it generates its own revenues, your financial institution or credit union may come to you, or your development lenders, they may come to you and ask you to sign a personal guarantee. So personal guarantees can either be unlimited, so you agree to the lender being able to recoup 100%, or you may be able to negotiate a limited personal guarantee. And this is where you set a specific dollar amount on what can be collected. So those are your personal guarantees. Very standard when taking out debt, that this will be required of you to sign. Okay, so aside from a personal guarantee, your lender may also require you to ascribe security or collateral. So these are physical assets that the borrower can put a specific charge on and use as security for their loan. So it mitigates the lender's risk by having access to an asset that they may be able to sell to recoup their losses. So some of these assets may be, your own personal home, or maybe you own your business property, any machinery, vehicles, newer vehicles, or GICs. This, at the end of the day, what this really does is, by offering the security, it does reduce the lender's risk. And with that, they may be able to offer you better terms or lower interest rates, because then, if you're working on a strictly unsecured loan. Okay, so when working with financing options, you may also be required to pay out fees. So this is a list of some of the fees that may be required of you. So first and foremost, we're looking at an application fee, how a fee to just apply. Maybe there's disbursement fee if you need to pay when your funds are dispersed to you. Excuse me. Maybe your loan has monthly management fees or administration fees, or there's an annual renewal fee at the end of each year, or other administration fees. So when you're working with your lender, be sure to ask these questions of, what fees can I expect to pay now, and what fees may be recurring monthly or annually. Okay, so make sure you're on top of that so you get no surprises. Okay, so everybody's favorite topic here, interest rates. Am I right? So your interest rate is the price for borrowing money. So that interest rate is based on your outstanding balance of your loan and is paid out monthly. That rate may be fixed or floating, and some lenders may add a variance on top of that rate based on a total risk. So currently, the Canadian prime rate is at 3.7%. So to give you an example, at WeBC, we use prime rate, plus we add a variance on top of that. So that variance is reflective of the total risk. So we're looking at stage of business, industry, what the money's being used for, if we have any security. And after that analysis, we have a better idea of what the total risk is to us and how to price accordingly. Okay. So of course, we have to start thinking about our repayment plan and how to pay back that loan. Your monthly payments will include your principal and your interest. You may be able to negotiate seasonal repayments with your lender. So if you have a business where primarily most of your revenues occur in the summer, it may make sense to do to pay larger repayment portions in the summertime in the busy month and smaller payments in the winter months. Or you may be offered an interest only option at the beginning of your loan, you know, or throughout the loan if you're coming across some slower times, etc. So as I previously mentioned in a few slides before, it's really important that you align your repayment over the life of the asset or investment. So if you're looking at a short-term need like purchasing inventory, it really doesn't make sense to use a term loan to do that. It makes more sense to use a line of credit. So you have access to that line of credit to purchase your inventory. Then once you sell it in 3 to 6 months, you can pay back that line of credit. And you have access to that line of credit to purchase more inventory for your next cycle. Okay, everybody, that is understanding your basic financial literacy. What we covered today is what is capital, what that means, when to determine when you need it, what are some financing options, and how can I prepare for solid financing application, my personal credit score, and why it's important to me, understanding agreements and their terms, looking at interest rates, and also talking a bit more about security and collateral that may be required when accessing capital. Okay, so I'm going to stop sharing my screen here so I can see all your lovely faces, and I will open up the floor now for questions.
So Sarah, Janet had her hand earlier, hand up.
Okay.
Do you have a question?
Was that Janet?
Yeah. Okay. So there was another question in chat. Rosie was asking, is it true that checking your credit score too regularly will lower it? And somebody posted a link to Equifax as an answer, but I think maybe you can also quickly answer this question.
Yes, that is correct. You know, the more times your credit is being pulled, it will impact your score. So if you pull it personally, one time online, it does not impact your score. But if you are applying for several different loans with several different institutions, all those institutions will pull your score and it does impact it. So just be sure that when you are applying, you're asking them if they're pulling it and to make sure that it makes sense for you to continue on with that application. So something to keep in mind.
Thank you, Sarah. Nancy, you have your hand up. Would you like to unmute and ask your question?
Hi there. This is not so much of a question, just a comment. Just to mention once again, like it's so important about the credit, to have a good credit score, because even though sometimes the business might not be under your full name, like it does affect your ability to get credit. Like I recently went to Futurepreneur and I was denied, but I do want to mention there are other options for small businesses. Like we do use Square to do all of our transactions, and we were able to get over $30,000 through them with no credit check, no paperwork, just based on our future sales. We just click a button on the computer and the money was in the account the next day. So if anybody has bad credit and is like needing even some cash flow, if you're using a Square or if you're not, I suggest go ahead and use it. They do have a great lending program based on your sales, and they just take some, they take a percentage of your future sales as well.
Awesome. Thanks, Nancy.
Yeah,
Thanks for sharing that.
Thank you.
I will mark that down as well. That's Square. Okay.
It's Square, yes.
Square. Awesome. Thank you for sharing.
Sarah, Victoria has a follow-up question on the credit score as well.
Okay, sure.
Does that include Credit Karma?
Credit Karma, I believe, is an American company, but I am not 100% sure on that. I can definitely look into that, but I'm not familiar with Credit Karma, and I don't believe that most of the Canadian financial institutions use that. They will stick to TransUnion and Equifax. Wonderful. Do we have any other questions from the group? This is a safe place. Any questions about money? Fire them at me. Sheena, if you want to unmute yourself. Oh, hi, Sheena. Oh, you're just on mute. Sorry, Sheena.
Good morning, and thank you for the very informative session. I have a question on the non-traditional lenders. So we have WeBC in here, and my understanding is that you mentioned earlier that it's for long-term, like a long-term loan, right? How long is it? I know it's a case-by-case basis, but like an average.
Yeah, typically 5 years is a good term. We can do shorter periods than that. And of course, we have the flexibility, you know, if it makes sense and you want to pay out your loan or a portion of your loan, you can do that before the 5 years without any penalties or prepayment penalties. So yeah, typically around 5 years.
And I have a follow-up question.
Sure,
I'm not sure if it's okay to ask in the group, but so currently, I'm sorry, the current Canadian prime rate is 3.7. And what's the average top-up that WeBC?
Yeah, good question. Yeah, so that's the variance. So the variance is reflective of that total risk. So the variance can be anywhere from 2%, which is something that's fully secured. Maybe we have a personal asset that we're able to secure our loan, to up to 5%. So that 5% could be fully 100% unsecured loan for a new startup company, for instance. Yeah, so the range is about 2 to 5% on top of your prime rate.
Can I ask one more question?
Yeah, of course.
What's the difference? Because like under non-traditional lenders, you mentioned the BDC is unsecured. So what's the difference between secured and unsecured? I may have missed it. Is it with the collateral or?
Yes. So that's your collateral. So at WeBC, our loans, we need to secure a minimum of 30%. We do have an unsecured loan program as well. But if you're looking at more than $50,000, we're looking at 30%. So we can look at both personal and business assets, and we'll collateralize against those specific assets. Somebody like BDC, they may not require that. So they can look at doing a 100% unsecured loan. It's basically secured by that personal guarantee and a GSA from you. So they're not looking at collateralizing on a specific asset, unless of course you are financing let's say a large piece of equipment that you need for your business. Then both WeBC or BDC or Community Futures or even Futurepreneur, they may look at putting a specific charge on that piece of equipment. Does that help, Sheena? Did I answer that?
Yes, thank you very much.
Okay, no worries. Do we have any more questions? We're quiet.
We have another question in chat.
Okay.
Cindy is saying, I'm a consultant, but my computer or designing skills are limited. Is it worthwhile to get funding for developing the training program? How would you assess this?
Okay, so Cindy, just so I can understand, you're a consultant, but you're looking at developing a computer program for your business to sell or to use within your business. Can you just clarify on that? Oh, to sell. Okay. So yes, Definitely. When you are looking at developing a new software or technology, it sometimes can be difficult to get that funding. At WeBC, we do not provide funding for pre-market technology services. So that's that, or R&D. So that's money typically is either financed through your own personal investment or through equity through investors. Once that service or that software is readily available and is available to sell, then we can look at providing a financing program, perhaps for marketing, etc., to get your product out there. Hopefully I answered that question correctly. Gwen, I see your hand up.
Awesome webinar. Thank you so much for doing this.
Yeah, thank you for coming.
I opened up my business mid 2020.
Okay.
I opened up I have a commercial cleaning company in Vancouver, well, New West, but it's for Vancouver, and sewing company. My business partner and I are sole proprietors with 50/50.
Okay.
That being said, you had mentioned majority of the company needs to be owned by, say, me versus my business partner, Dennis, in order to receive funding from WeBC. Is that correct?
Yes, so that is correct. We provide financing for majority-owned, women-owned companies. So if you have a male partner who is strictly just a business partner, so we would need to see that the woman owns or retains 51%.
Got it.
If you are in business with your husband or a common law partner, then we would consider a 50-50% ownership split.
Okay. Okay. Thank you for clarifying.
Yeah, no problem. Do we have any more questions? Any more questions in the chat, Netta?
Nothing in the chat so far.
Okay. I do want to mention that you will have access to this recording, and I will also share my presentation slide deck with you so that you can refer to that information later on.
Okay, and Sarah, we have a new question in the chat.
Okay.
How do you figure out the market research for other businesses in your area?
Yeah, that's a good question. That's your primary research. We just spoke about that in our meeting yesterday and how important it is that our clients take the time to do that primary market research. So that can be in a number of ways. Maybe you have to kind of set up camp outside your competitors and watch how many people go in and out of their store. If we're looking at a retail store, and kind of guesstimate what their average purchase cost would be, how many people are going to that store. Or maybe you're doing like polls online through Instagram, etc., or a survey on SurveyMonkey. It can come in many different forms, but it is difficult to get that primary research. But if you dig deep enough, and we've got a lot of information on the internet, you can kind of pick bits and pieces there. So it is important that you take the time. No problem. Hi, Sheena.
Sorry, I know it's not related to the topic, but just wondering what your opinion is. Would it be good for women or for us business owners to try to venture into grant funding if there's any availability for that first before we take out loans? What is your thoughts on that?
Yes, of course. Yeah, I mean, the offering is different. It is a little bit more cumbersome trying to find access to those grants, but it's definitely worth it to put that time in to see if you qualify, because that could be potentially free money. So it is worthwhile, and you weigh your options as well too. So I have several clients that have applied for grants, and there are other organizations that can help you identify grants that may be available to you. Like one to note is Granted, which is online, and for a service that for a fee, they can help you fill out those applications. Or if you have the time and you want to do it yourself, I have some clients that have employees that spend majority of their time applying and monitoring those grants within the company as well too. So yes, of course, it's definitely worth your time looking into that.
Thank you.
Yeah. So any last questions? I do want to share my screen one more time. I'm just going to share that here. Okay, I'd like to note some of the wonderful upcoming series and webinars that we have offered at WeBC. If you don't already, highly encourage you all to check out our website. We have access to previous recordings, sessions that may be of interest to you. Also suggest that you sign up for our e-blast. There's a link directly on our website to stay in the loop of all our fun and exciting sessions that are coming up. I do want to highlight that we do offer a free business loan information session bi-monthly. This session is a phone call in, and the next session is occurring on June 28th. And in this session, we go through our loan application process in great detail. So it really spells out what it is that you need to prepare if you are interested in applying for funding through WeBC. Okay. In combination with that, we also have on July 6th, we have your Build Your HR Toolkit. It's a 3-part webinar series. And we have several sessions that are happening later throughout the summer and the fall. So be sure to register and subscribe online. Okay. I'll stop sharing again here. Okay, so Netta, do we want to send out the poll now? Yeah, so if everybody can just take a few minutes and fill out this super user-friendly poll here, just to let us know how we did, what can we improve upon, and any suggestions for future topics that you would like us to explore. Okay. So I just want to take the time to thank you all for joining us today. I hope you found some useful information in this session. If you have any further questions, please do not hesitate to reach out to me. My direct email is Sarah with an H at we.bc.ca. So have a wonderful rest of your day and a beautiful summer. Thank you again.